Hello, and welcome to another live webinar with us from Phillip. And this is your facilitator of the day. My name is Sri, and what will we be discussing today? Well, more recession signs seem to be appearing, and what's the strategy to trade Singapore stocks? Key talking points for today, with inflation expected to stay high in the first half of 2023, market participants seem to be swinging back to the 2022 inflation trend to long the USD and short bonds and equities. Closer to home, what does this mean for us, and what's the strategy to trade Singapore stocks? With us in the studio is our very distinguished guest. We have Paul Chu, who's the head of Phillip Securities Research. Gives me great pleasure to have Paul in the studio with us. Paul has over 20 years of experience as a fund manager and sell-side analyst. During his time as a fund manager, he has managed multiple funds and mandates, including capital guarantee, dividend income, renewable energy, single country, and regionally focused funds. He graduated from Monash University and has completed both his CFA and Australian CPA program. Before I hand the reins over to Paul's good hands, can I just do a quick poll to check if you can hear me loud and clear? All right, thank you so much for verifying that you hear us loud and clear. Paul, I'm going to give you sharing rights right now, and you can walk us through your insights for today.
Okay, thanks so much. Okay, I'm going to share, so just bear with me. I'm not too familiar with this. Okay, sharing. Okay, sorry, give me a minute. My apologies.
No worries.
So, have you you've given me the rights, right, to share?
Yes, I have, Paul. Do you not see the prompt on the screen?
No, the sharing part. No, I don't.
Okay, let me try that again.
Okay, can you
You
see
see
my
now?
screen?
Yes, I can.
Yeah.
Cool. All
Okay.
right, over to you, Paul.
Okay, thanks so much, everyone. So let me just I'll just turn off my since there's no okay, so sorry for the technical delay. So thanks, everyone. So I'll just give an update of how we see the Singapore market and what is the equity strategy. I will usually break it up with just a quick run through of what has happened, then what are some of the macro themes, the sectors, and then the stocks. The usual typical disclaimer, these are our views. We take a lot of information from the public, which we can't rely on, which we can't verify independently. This for this for general circulation only. And please seek your advice from a financial advisor. Okay, with that out of the way, so let me just run through a quick review of the Singapore market and various asset classes, the performance up to end April. For Singapore, as the picture suggests, it was a smooth fest in Singapore. So, okay, let's just go first to, on your left would be Singapore market, then you go to REITs. So you can see that the Singapore market year to date is basically up about 1%. Basically flatlined the whole of for the last 4 months. April was another snoozer, with hardly moved. What performed better was REITs. Asia ex Japan was also sideways, maybe up 2%. The strongest markets that recovered from last year's major sell down was the US, in particular Nasdaq. And as the title suggests, the one unusual part is that usually Nasdaq is seen as when growth is coming back, global economy is stronger. This way you want to participate into the tech sector, but this not consistent with where the commodities are trading. So this is more specific to the big tech names. So a lot of it has to do with all the although revenue growth is slowing down, I mean, we do have coverage on these US large cap big tech names. So what's basically happened is that basically a lot of cost cutting that has kind of propped up earnings. What has done well in the other asset classes has been gold and also bonds, as I guess the main theme is disinflation, and with interest rates peaking, these are the asset classes that will perform well. In terms of equities in Singapore, on the top left are banks. So banks was hurt badly, especially UOB. I think what was one of the reasons that triggered the sell down for UOB was in the most recent results, they actually saw NIMs contracting, which is unusual because interest rates are going up, but their NIMs or net interest margins contracted. So that was one of the reasons it was weak. OCBC, no, we'll delve more on it later. OCBC did better. We think is that their strong dividends is holding the stock. So this stock is trading at 5% plus in dividend yields. And I think that is the one metric that's holding the performance of the stock. No, because if you're getting such an attractive yield, then no, it becomes like a defensive stock in nature because of the strength of the dividends. Conglomerates continue to do well because of re-rating and also Keppel because of the whole re-rating of interest rates peaking. And we see this across the board also for all the REITs. In particular, logistics. Logistics REITs have generally been a better performing class because logistics have the rental reversion have been stronger, and they were not hurt like office and also retail to a certain extent. The underperformance was CDL. It was already underperforming, but it didn't help that we had property cooling measures. Okay, I'll just run through some of the macro themes. We do macro themes mainly just to equip investors as you trade or as you invest. Like, what are some of the talking points that one should be aware of? So the main theme, macro theme, we think this year is all about whether global economies, especially the US, of course, is on a disinflation path. So this is critical. If you recall last year's, the most important theme was did you think that inflation was rising? So if you got that right, then you would have known bonds would have been sold down, and you could have adjusted your portfolio to take advantage of that. And the prior years was, of course, the pandemic, the trajectory. So every year, virtually, there's always one particular theme that is core. We think this year the core theme should be disinflation, as we see inflation rates start to decelerate. So I know this is a very noisy chart. We promise this is one of the only noisiest chart that we have with so many lines. So the CPI in red, this is the US CPI. So you can see that it is starting to decelerate, and that is great. But the problem is the blue line, which is services. So services is stubbornly high, and also so one of the reasons it's stubbornly high is because wages and the whole reopening. So if you look into close details of the US job market, for instance, or even retail spending, almost half or more of all the growth in jobs is coming from services sector, restaurants, leisure, and likewise retail spending. Most of it has been going into leisure activity, restaurants, and so forth. So that's why the services sector continues to be stubbornly high, and services ex shelter is also starting to collapse. So for us, we think that the trajectory for inflation is still coming down, and that's critical for investors if they are positioning their portfolio. So one of the reasons is because real-time data continues to drop. So if you look at so this is the red line is CPI, which is inflation. The blue line is commodities. There are many types of indexes, but we just picked this one has the longest track record or longest data. So the CRB index. There's industrial commodities, agriculture. So you can see that it correlates very well with the CPI. But you notice it started to drop quite significantly, and we can only assume that the CPI will continue to deteriorate, the US CPI, in line with what has happened historically with commodity prices. The other thing that's starting to slow is also wages, because services now, just like a manufacturer, the manufacturer's cost of goods will be materials, electricity, utilities. So for a service industry, wages will be the biggest. So the biggest cost item is usually employee costs and wages. So what we do see is that even that is starting to decelerate, even in the US, despite having full employment and so forth. Another pressure point, and this is what the Federal Reserve looks at very closely, is always inflation expectations. So because of what happened in the 1970s, the biggest worry the Fed always has is that if inflation expectations remain elevated, then you get this very terrible spiraling. That means if I expect inflation to be high, I will want higher wages, and because of that, you get this negative loop of higher wages causing more inflation, and expectations continue to be elevated. So this is the part where the Fed is always very wary of. Although it's very hard to measure, that this is that you can use the financial markets to measure. You can use surveys. So I'm just using the financial markets to measure. So the good thing is that inflation expectations are starting to trend down. Core PCE is what the Fed always, whenever you hear the Federal Reserve talk about inflation, is always referring to this particular term, core PCE, because it's a more broad-based inflation indicator. So the red line is where the Fed is targeting his so-called famous 2%. He always talks about trying to hit the 2%. So what you see in the box now is, if we extrapolate based on March, the latest number in March, month on month, it was growing about maybe 0.2%. If you extrapolate, we are trending down, and hopefully the next few more months, you will see it trending down even sharper, that we could actually come close to the Fed's expectations of 3.5% by end of 2023. They think the 2% can only be hit by, I think, end of 2024. But if there's more signs that the growth in CPI, as we at least month on month, starts to decelerate, which we think it will, then we could it's a bit more visible, the trend line, that inflation will hit to his 3.5%. This is like a forecast, but based on the most recent March number. We just take month on month. We assume this 0.2% month on month continues for the rest of the year until December. The worry is that it's only starting. So if you use the last 3 months data, inflation is still pretty high. So it's not yet time to pop the champagne and celebrate that based on the current numbers, but the recent numbers continue to drop. So there is room, and this is something that we will continue to track. At least there's a path for inflation to hit the Fed's objective. Then it gives more room for the Fed to, at the minimum, pause, if not even cut rates. So the next theme will be, of course, all about recession. I think we've heard about this. I think it's more than 1 year there's always been talk about recession. And this is the most famous indicator. Everyone will use this because this is the best economists, because this has predicted so many recessions. So if you look at this, the beige line is basically recession, and you will notice it always inverts. So inversion means that the 10-year, basically, like we always repeat this term, the 10-year fixed deposit is lower than your 2-year, which shouldn't be. I mean, longer term, most investors will want higher rates if they're going to invest longer with you. But when that inverts and that goes to the negative, it's usually a sign that recession is coming. And the funny thing is, once it starts, the inversion narrows. That means if you see this blue line start to climb back up, it actually means that you're coming closer to a recession. But the problem with inversions is that they don't give you the exact time. It could be a year, it could be 6 months, it could be 1.5 years. But the problem is that we just cannot ignore all these indicators, because there are other indicators out there. But what we do think is happening is, at least the manufacturing sector is facing some modest form of recession. You can see this from the PMI. So these are survey numbers, and you can see from the last 2 recessions we have, of course, the global financial crisis, the steepness of the drop, and also you see this in the COVID recession. So that has also been dropping steeply, and also services is also starting to drop. So we think recession, probably in the manufacturing sector, is where they are facing some form of modest recession, or the goods sector. The other reason why we say this is that if you look at US imports, that means actual containers going through the LA, which is the main terminal, which is the main port for importing goods, because especially it comes all from China and Southeast Asia. So you can see that container ports have dropped very significantly. It dropped it's now down about 30% year on year. So these are in blue lines, basically the year-on-year drop, and you can see these are levels not seen since the global financial crisis. So The absolute numbers isn't as bad. So these are the absolute TEUs that's going through the port of Los Angeles. But you can see here that it's not as bad as what happened in terms of absolute levels, but you will notice that the percentage change is dropping. So manufacturing is hurt, as you can see through. These are real data. That means if there are fewer container imports, obviously it means that there's less goods being imported, and because the demand is also down. And the other thing, what we do see is also the US retail sales is also contracting very sharply. The most recent number was one of the slowest growth since the 4% growth that they saw in March was one of the slowest since the pandemic. So many more signs that things are slowing down in the US. But the other problem, not to make matters worse, because demand is really weak, but the inventory in the US. So this is the US retail inventory. The inventory in the US is roughly about 700 plus billion. So this is the growth in inventory. So you'll notice that when the pandemic, there's a huge destocking in 2020, then they restocked aggressively. I think, but the problem is that because of not just in time and just in case, now just too much inventory. So the problem now is that in 2022, the inventory just got overstocked. So I think you will see news in Vietnam where these are some of the countries that are being hurt the most. The retail in the textile industry, the garment, the shoes, and so forth. Those are industries that are hurt very badly right now, because the demand has contracted, furniture and so forth, because the demand has contracted so sharply. And the problem is that they are still piling up inventory. Even in the first quarter, it's up 10 billion for the first 3 months, even though we saw earlier retail sales. So there's two problems here. You have too much inventory, but at the same time, retail sales is coming down. So we think the manufacturing sector will probably face quite a long winter, at least for this year. And of course, unemployment is something that the Fed always like to say, unemployment is still good. But the problem is unemployment, which is full right now, is unemployment is always it's a lagging indicator. So you'll notice that the time when unemployment really turns bad is you are already in a recession. So when if the Fed keeps on relying on unemployment as a signal, it's too late. Then by the time it increases, increase means that the labor market is turning bad. That it's really too late because we are already in a recession. As you can see from the global financial crisis 2008, when it started to creep up, we were already in, and when the time it started to tilt down, we were already out of recession. So it's a notoriously lagging indicator, which one shouldn't use to time where the economic cycle is. But having said all this doom and gloom, the US is likely to face a recession. The bright spot we do see is, of course, China. Of course, you get the usual data, because I'm not going to go through all, because China's data, there's reams and reams of data for China, but we just wanted to show one particular one, which is the amount of loans that's being dispersed into the Chinese economy. And in China, the banks run on the quota system. That means the central government will basically tell you how much you have to lend. And you can see that the net amount of loans being dispersed. So this is not the total. This is the net new money going into the economy has spiked up to almost 24 trillion RMB. This is a record level. So this is going to be a positive, because this is usually the lead indicator before all this money starts to roll into fixed asset investments, property, and so forth. Although we are not telling investors to buy, like the usual oxymoron, to buy into China through Singapore. I mean, nobody does that. You just buy through Hong Kong. But it is important because a lot of Singapore companies are relying on China for growth. You can, like Wilmar has a major presence in China, capital and investments and so forth. So although we do not advocate buying Singapore stocks to get exposure to China, but what the point here is that if there's a strong rebound in China, it's going to help a lot of the listed companies in Singapore. We calculated almost 2/3, if I'm not mistaken, will have some tailwind behind recovering China. Of course, the other theme we think is interest rate has peaked. And of course, just to sidetrack, I think we had the Fed just completed their meeting, and for us, we think the two things which there was a bit of hint that he might pause is because, firstly, he said in the last statement that he didn't include the statement where they're going to raise. So that was his indirect way to say that there's a difference now. And they also said that they push rates to 5 to 5.2, and it's already meeting their forecast. So if you look at the Fed's forecast, FOMC forecast, they're already forecasting like 5.1 by end of December, and that is already within their forecast. But anyway, in terms of where the market, I think the market is a bit too aggressive. The market is expecting a rate cut, or 3 rate cuts to be exact, in the next upcoming 5 meetings. So this is the expectations of the market. Right now, interest rates are 5 to 5.25. But the market still expects it to go to 4.2, which we think is a bit aggressive, but I mean, that's the forecast. Even the Fed is also expecting a rate cut by 2024. For us, we think any rate cut is only going to be in 2024, unlikely to be in 2023. But this is what the market is pricing, just for reference. So the other reason why we think interest rates have peaked is, the problem is that why we see all this headline news about the banking system in turmoil in the US is, the main reason is because of this rate line. So when the pandemic happened and the government had this massive stimulus, the US banking system enjoyed a tremendous surge in liquidity, almost 4 trillion, as you can see from this chart. So the US banking system, the banking system's deposits was about 14 trillion, then it shot up to almost 18 trillion at the, or more at the peak, slightly above 18 at the peak. And the problem is that when you have, the problem is when they had so much of these deposits, where do you park? There's not enough places to lend. So in fact, most of it actually, or 1.5 trillion of it went into government bonds. And when interest rates collapse, bond prices collapse, that's what happened to Silicon Valley Bank, which we will elaborate. So one of the reasons we think the Fed also cannot raise too much, because a lot of banks here are sitting on huge losses. And it's only, I mean, by looking at this chart, you can compute it yourself, because you can see that from here, anyone buying bonds here is going to lose money. Because the only way you make money in bonds is if you have bought it here, and most of them, there was 1.5 trillion of bonds, government bonds, mortgage securities, all being bought, and all these are, of course, are facing losses. But just that because of the way the accounting is done, you don't have to recognize it yet until you sell them. But if the Fed were to keep on raising rates, these losses is going to hemorrhage the bank's balance sheets even further. So that's one of the reasons. And the other thing is also why the Fed can't raise rates is that the banks are already tightening. Even this is up to January 23. So you can assume that when the next data point comes out, I think on 8th of May, this tightening standards. So this is a survey done by the Fed to all the banks on are you tightening your lending or are you not? So obviously, like any typical banker, they tighten when you need the most. So they always tighten, when you need the money the most. Of us, the banks are famous to tighten it. So you can see it for yourself during global financial crisis when everyone was scrambling for money. That's when the banks tell you, no, I can't lend you. So when you don't need it, like this boom times, that's where they come. So you can see that the banks credit tightening standards we think could be as high or as tight as during the global financial crisis, when we see the next survey coming up in just a couple more days. And the problem we have with the market positioning is that whenever the Fed cut rate, is actually quite a bad time for the market. So you will see here, this is the red dots. So whenever the Fed cut rates, you can see that the market actually drops. This happened in 2001, the Fed cut rate, and then the equity market in blue line actually peaks when it starts to cut rate. Again, it happened during the global financial crisis. The Fed cut rate, of course, this only, it all depends on how deep is the weakness. So it doesn't mean Fed cut rate will start to sell the market. But historically, it hasn't been a very good sign whenever the Fed cut rates. But for us, we think that because the recession will be modest, so even the Fed cut rates, you may not actually see such a severe downturn in the market. But we have to see how deep is this recession going to be. Okay, then we swing back to Singapore. So for Singapore, it's definitely going to be slower economic conditions. Like we told you earlier, the external environment is slowing down pretty sharp, and we see it in the exports. It is particularly bad for electronics. So electronics exports, if you look at the red line, it's collapsing pretty fast. It's actually down almost 30%, and it's accelerating. The steepness is actually accelerating. and it's almost close to the global financial crisis when when global economies were all slowing down. So that's why we think that manufacturing sector that's the pressure point right now. They are the ones facing the so-called recession, because a lot of demand was pulled in during the 2021 2022, because everyone, of course, we all know everyone was stuck at home and buying too many things that they don't need. So that's why the electronic sector is the one that's facing this huge weakness. And these are some of the worst. And my last point is that this is not unique to Singapore. I didn't want to pull a chart, there'll be too many charts here. But if you take a look at the Taiwan exports, Korean exports, they are the shape of the curve is all the same. They're all facing a sharp downturn. I just didn't include because there's just too many slides. But for Singapore, things are good. If you can look at this, the jobs in Singapore are ample. So the blue line is vacancies. Although it's not as high as it has maybe peaked in 2020, in probably late 21, but you can see it is still ample at 90,000 or more, and the ratio here, which is the vacancy to unemployed, so it's about 2.3. So what it means is that for every one person unemployed, there's at least 2 or more jobs for him. So the more jobs available, there's a huge number of jobs available for everyone, or double for every person who's unemployed. And why the demand, why is Singapore resilient, is one of the reasons is our foreign direct investments. It's probably not very well flagged out in the press, but anyway, foreign direct investments in Singapore is at a record high. I mean, marginally, but at least you can see here the number here, 141 billion US foreign direct investments into Singapore. The problem is that there's not much granularity, so we can't really dissect it and see where is it coming from. But the data says that there's 141 billion. It's just marginally better than 2021, but anyway, this is still a record number, so we can still celebrate in that sense. Another reason why Singapore economy is doing well is, of course, the reopening is been triggering visitorship. So you can see here the most recent number, for the first time since the pandemic happened, we crossed the 1 million in visitors compared to 121. Visitors is important. Of course, Thailand usually gets the headlines of 40 million visitors, but if you look at the population, there's like 70 million. For us, we have 5 million population, and in 2019, the visitors were like 19 million, so like, I don't know, 4 times more than our population. So tourism is important, because tourism gives about 5 percentage points of GDP, which is huge. I mean, like I always mentioned, Singapore grows at 2-3%, so 5 percentage points is a huge number. So tourism is another backbone to the economy. Construction is, but I will talk about it later too, but that's another extra fiscal spending. And maybe, and this is because this hinges on political statements, so we just say maybe there might be a rebound in the population in Singapore. The reason why we say that is that if you look at the white paper in 2013, they had 2 scenarios. You either had 6.5 million by 2030, sorry, not 2029, yeah, sorry, 2030, and or 6 point, the high and low case. So right now we are hitting of course we're not hitting the high case, we are neither hitting the low case. We are only about 5.6 million population, and if you want to hit the low case, you need to hit at least 5.9, around 5.9 million, roughly, if you were to hit the low case. And the only one data point we got was at least in the parliament statement, was that the infrastructure being built now is for 6.7. So I mean, logically, I don't think they're going to build 6.7 to have only 5.6 million population. So we think we can only guess that if they want to hit the low case with all this infrastructure built, they might see a ramp in the population. And I think one of the reasons, of course, the aging demographics, there are probably more grandparents and probably grandchildren. The aging demographics, if you don't have the population, then the economy cannot grow because no one is filling the jobs. And if that happens, of course, it's going to be good for the economy, good for retail, all the domestic industries, and so forth. Okay, so we just move on to sector trends, then we just talk about stocks, and then we can move on to Q&A. So for sector trends, our focus will be mainly REITs and banks. I mean, we cover a lot of sectors, but I'll just narrow down on these two. So for REITs, or we actually are overweight on REITs. It's a bit of a macro call for us for REITs, because with rates peaking, you generally want long duration assets. So that's basically our team here. If rates peak, what you want to buy an asset that can give you a yield and for a longer term period. So we think the REITs are attractive in that sense from a macro point of view. In terms of valuations, they were very the higher it goes, actually, it's the more attractive they are. So how you read this chart is that this is like, let's say a REIT gives you 5% dividend yield, or 6 these days, but whereas the government bonds is 4, so the difference is 2. So if the higher it goes, it means, hey, it's great. That means I'm getting more return from the REITs than what I can get from your FD or from government bonds. So the higher it goes means the cheaper, the more attractive. So right now it's back to probably the average levels compared to history. So if you buy a REIT now, you're not getting like poor returns, or the yield that you're paying is no more or less within the historical averages compared to government bond yields or fixed deposits. That's an easier comparison. So no, it's like, whether do I put money in the S REIT or do I put money in the FD, and this will be the difference that you will be paid with a Singapore REIT. Okay, this one is, I'll just do a quick one. This one shows that the REITs are obviously very sensitive to any increase in interest rates. Although I put here 100, but you can see interest rates didn't go up by 100, just ran up by at least 300-400 basis points. But because of hedging, you will not see the full impact, but it will impact the REITs. So it will just be, instead of having all 1 year, it'll be, most of them hedge over 3 years. So you're going to face the headwind of higher interest rates for the next 3 years. But what it does mean is that DPU cannot grow. So don't expect DPU growth from S-REITs, because organically, even though they may grow rent by 6-7%, most of it will be just to cover interest rates. And you cannot also grow by acquisitions, because interest rates so high, and the cap rate, that means if let's say you buy a property that gives you 4% and interest rates are 4%, there's no carry. So right now it's a bit difficult for them to make acquisitions until interest rates come off a bit more. So that's why they don't expect much growth. And even in the first quarter, those REITs that do announce a quarterly dividend, they were either flat or down single digit. But this is within expectations. I think we know that. But because interest rates, we think, have peaked and will be coming off, at least the bond yields have been started to come off. That's why we still write REITs from a top-down perspective. In terms of banks, this is just a chart on interest rates. So you can see that the Singapore interest rates, which is in blue, the SORA, which is not the line you want to see if you have a mortgage, and you always get this reminder by the banks. So because most of the loans are pegged off the 3-month SORA, the blue line, you can see that one thing unique about Singapore is that the transmission of high interest rates in the US gets translated to Singapore very fast. So when rates in the US rise, there's like almost a 90% correlation. Interest rates in Singapore will also climb up. We added one unique one here, which is HIBOR in Hong Kong. So that is one negative for DBS and even for OCBC, because they have bank operations in Hong Kong, and when rates come off so sharply for them, it's not so good for their net interest margins. It's of course better than a year ago, but it has been a dampener to their net interest margins. This is just our reference. But we still think it will be a strong NIM growth for the bank. So for 2023, 2022 was a banner year for the banks. Their net interest income grew like a tech stock, up 40%, 50% growth in net interest income. Net interest income, and we think it can repeat, but maybe we might have to shave this a little bit, because some of them are guiding a little bit down. So we think maybe may not be 2.16, maybe 2.1. That's a slight shading, but banks will still enjoy a strong growth in 2023. And the next driver for growth for the banks will be fee income, which is starting to recover. Year on year is still down, but quarter on quarter, you can see that the fee income is starting to grow like 30-40%. So there is a big recovery for the banks in fee income. So this year, we think banks' earnings growth will be probably in the mid-teens range. Okay, so this is just a quick snapshot of the banks. So you can see the banks, like their revenue, their net interest income grew like a tech stock is up 50%, 43%. The only negative for me at least was the CASA ratio, which is down, but I won't go through too detail on this. But basically, this is the golden goose for the banks. This is CASA means current account, savings account, zero interest rate loan. This is not deposits are like loans, rather than call them deposits. So these are like zero interest rate loans, which we always say, if you give me a zero interest rate loan, I can also show you a good time, right? So the banks enjoy it. So like DBS has 300 billion of interest-free, zero interest rate loans. I mean, who can't make money from that? Okay, but so that's the benefit of CASA. But the problem is because rates are up, so that has been coming off pretty sharp. But it's still very high compared to many banks, even globally. The 52% ratio. So far the bank numbers have been within or slightly above expectations. You can see here, this is the PATMI, this is the earnings growth of the banks, up 43 for DBS and up 67. Even though it's up, the problem is even though you're up 67, your stock still got sold down because your NIMs are slightly down. Okay, this was a quick snapshot we do with the Credit Suisse, Silicon Valley Bank that collapsed, and of course First Republic. Okay, so for Credit Suisse was the one thing that stuck out, the red flag, so-called, was because they were losing money. I just call them very accident prone. So they had losing money. So that was one red flag. Silicon Valley Bank, the red flag was basically most of their assets, they just put it in government securities. Like we showed you earlier, then when interest rates collapsed, they took them into a huge loss. Yeah, and they wanted to raise money, but the problem was the market got wind of it and the depositors started to run. The First Republic was a bit more challenging. So First Republic, if you look at the metrics, they're almost same. They have, let's say you take a Singapore bank, 15% here, 15%, LD ratio, quite similar. Maybe the equity a bit slower, but there wasn't any particular kind of red flag for them, which is a bit of a problem because but the main red flag actually came from deposits. So for Silicon Valley Bank, over the last 3 years, up to December 2022, of course, the deposit after that went back to, of course, if you do the most recent quarter, it probably collapsed back, but their deposits actually tripled the last 3 years. For First Republic, their deposits doubled. So because for them was that the depositors, these were not seasoned depositors, they were just virtually hot money in the sense. So this money came in because it doubled, and then no one can escape a run, a bank, or even a country run, like the Asian financial crisis. But when that run, because the deposits just spiked up so much, they just couldn't cope with it. They lost 100 billion, and within 7 days of announcing there was a 100 billion decline in their deposits, the bank was closed. So this is pretty scary in the sense, if any bank shows a huge deposit run, you can just put the timer on 7 days and you are out virtually. So you can imagine any bank out there, why would they want to lend? I mean, they just want to show up their balance sheet. That's why that is the worry you're going to have in the US. No bank CEO is going to lend money. They just want to show up their deposits and not lend, and show to everyone that my deposits is so strong. There's no sharp leakage. Because otherwise, you're just 7 days away from closure. Because they announced it on the 24th, the results, and then by the 1st of May, they are out. They were already seized by FDIC. So for Singapore banks, the difference is that we didn't grow that much, the assets. Okay, I know I'm running a bit short of time. Always talk too long on each side, but okay. So the other unique thing for Singapore is that we're getting this huge multi-year opportunity. You will notice that construction activity in Singapore is like a roller coaster. Sometimes it's good, sometimes it's bad. But the next 5 years is going to be quite stable because the government is funding a lot off balance sheet. The government is spending an extra 90 billion through the Singa bonds, which they usually won't spend because the budget will always have, there's always a fiscal balance, right, where we have to do, but they're going to take 90 billion off the balance sheet, and this is going to be going to spur construction activity for Singapore for infrastructure. But basically the bill will be paid later because it will only come into the budget when the building, let's say you have a 10 billion worth road, once you complete it, you only come in the budget when you start depreciating it. But when you first spend it, it's not in the budget, so you can spend 90 billion without worrying about it in the budget. So that's why it's going to be an extra stimulus for the construction sector. Okay, I'm going to run a bit faster here. So for semiconductors, the cycle is down very sharply and is down sharp. So no, you're going to find it very rare any semiconductor company announcing any good results, because you can see from here it's contracting. We think probably this contraction could last until the end of this year, based on the previous cycles. For property, we can only say is that the new launch in Blossoms by the Park was sold 70%. The new property measures only doesn't hit first timers, and based on 2022 stats, 80% of buyers did not pay us any ABSD, additional buyer stamp duty. So that's why what's affected is mainly the high end. Okay, and valuations in Singapore are attractive. You can see here on the PE basis, they are at the low quartile here. So the lower here is cheaper. If you take the earnings compared to high interest rates, because you might say, oh, interest rates are so high, is it worth? But if you take that compared to the 10-year government bond yields, you can see that the Singapore equities are also attractively valued. So I'm just going to run through the stock picks, and hopefully we have like 10 minutes for Q&A. Okay, so this is our model portfolio. Again, it's purely for illustration, the performance, but so this is our typical model portfolio. We call it absolute 10. I know everyone said, is it vodka? No, it's not. It's absolute 10 for absolute return. So we had 10 stocks. We made it 10 just to make it simple, but obviously in a typical portfolio, you should have at least 20. But if you take 20, you end up just recommending every stock that we have. I mean, although we cover like more than 50, but so we put this so easier for investors to remember. So for us, we break down by yield, by stocks that we think there's growth, and then re-rating names. This is the performance again for illustration. Last month we did particularly well because we had Propnex performing well. Okay, I'll just run through some of the stocks. So one of them is actually Capital Land Escort Trust. For those who don't know, they are a trust with service residents. So they specialize service residents virtually across the globe. They have in Singapore, Europe, Japan, US. And for us, we just like it because it's just a straight out play on the rebound in travel and so forth. So the most recent numbers, I think the revenue was up, I think 60-70%. So because there's this huge rebound year on year, so you can see that the RevPAR, basically this is sales. You can virtually look at this as sales because this is the room nights times occupancy. Yeah. So this is not room rates, these are room rates, but you put in how much of the occupancy. You can see that it is up 155, whereas a year ago was 67. So it's like a tripling. And we think there's still room to grow because they also have Japan assets. We only start opening, and this is even before the China tourists start to roam around the world, roam around the globe. So we think it's still early stages, and it's paying about a 5.7% dividend yield. The next one we like is OCBC. The main reason we like it is just because of the dividend yield, and they are the most well-capitalized bank at almost 15%, I think, for their CET1, and most of them are comfortable with 13.5. So there's room for them to grow dividends. So the dividend yield, we think, based on our forecast, is at least it's around 6%, and also, we think with the extra capital and their presence in Hong Kong, and the rebound they're going to get probably in their insurance business. This is one of our favorite banks because of these reasons. We always think that with the high dividend yield, it gives support to the share price, because imagine if the stocks get sold down, then the dividend yield, because they are very unlikely they're going to cut dividends, because there's still going to be earnings growth. So you can imagine if there's any sell down, this is going to push this stock to 7%, 8% yield, which we don't think is going to happen. So that's why we think OCBC at these levels, I think now is historically it's about 5+ dividends, but our forecast is the growth in dividends, and you're probably buying it at a 6% dividend yield. The other one we like is SGX. Not so much about, we don't like them, not so much that there's so many listings coming to Singapore. It's the other way around, probably more exits than new listings. And anyway, one of the reasons is just high treasury income, which is a fancy word for interest income. So you will notice from this chart that the last time interest rates were so high, the last time they had enjoyed huge interest income of 130 million was because there's a bit of a lag. So was that interest rates were only at these levels. SORA was probably 1.5. So you can imagine now that SORA is probably 3 and higher, that their earnings potential is huge. So SGX makes about 400 million. So this, we think that they could double or even they could easily triple their interest income, and this will give the big earnings kicker to them, maybe around 20 percentage points growth kicker to SGX earnings. Why they have so much interest income is because of all the collateral balances that they collect. I think it's about 20 billion plus, 14 billion, sorry, of collateral balance they collect from all the clearing members, including Phillip Nova. So all these clearing members, they will actually park money with SGX. SGX will actually pay them a return, but most of it also they can earn a spread on the return. And of course, they can earn like 135 million in FY20, even though interest rates were only at this level. So you can imagine when interest rates are much higher, because most of it actually parked in US dollars, that the returns could be huge. So that's why for them, we think it's a huge tailwind for SGX. The other one is capital land investments. I'll try to wrap this up in 5 minutes. Capital land investments, which they have if you recall, this was the previous capital land, but they took out the property development, and what's left here is all the fund management arms, which is what Keppel is trying to do. So we like it because they can actually take a piece of land, which is why we call it from cradle, an empty piece of land, build a mall, then fit it with a lot of tenants, then sell it, that means to the grave, and then they earn some income, and even after life, that means after selling it, they will run it like a REIT or under some of the property funds, property management. So that's why very few companies have this whole vertical integrated. I'm sorry, they're horizontal. But horizontally integrated kind of model where they can take a piece of land and just go through and just take bites of return through the whole life cycle of a particular piece of property. This model wasn't so great when China was in lockdown. Interest rates are so high. Who's going to buy anything? There's no room to do deals. But now that China's recovering, because most of their assets are in China, 1/3 of their income's in China. With China recovering and with interest rates more stable, they can grow the fund size even more, and of course do more acquisitions and grow the pipeline. So that's one. So this is a pure fund management company, and we think the timing is better now because of the whole reopening of China and more stable interest rates. The next one is Capital Corp. We like it because they have another 5 billion monetization, 5 to 7 billion monetization plan to 2026. So most of the monetization is basically from their huge pipeline of properties. So in general, in any year, Keppel sells about 5,000 properties, but they have a pipeline of 39,000. So, and they want to sell, I think most of it they want to clear by 2026. So this means that every year they have at least 8,000 properties to sell. And this will be what they mean by the monetization. And some of it may not be outright sale. They might actually create a fund, put all this property in a fund, manage it, and get investors in it. So this is one way for them to also monetize. And so these are the growth trajectory for also Keppel, for Keppel Corp. The next, these are one of them because they have also another bigger plan by 2030. But anyway, we'll wait until 2026. The other stock that we like, which I think those who listen to my calls always talk about this stock, hopefully it rebounds this year, is also Comfort Galgro. Yeah, I know taxi, right? Yeah, but anyway, we think there's going to be a rebound in the earnings, which is the red line. And why we liked it was because there was also a balance sheet story to this stock. So pre-pandemic, this was their net cash 64 million. Then after the pandemic, the net cash actually grew 10 times. Of course, you'll be asking, like, it's a bit counterintuitive, but because of the pandemic, because they had government grants, and also they didn't have to spend much capex, they actually accumulated a lot of cash in those 2 years, and this will actually cement their dividend payout. And we again think that there's going to be a recovery because reopening, number one, and number two is also because the taxis, they've removed the rebates, and they've also put they're becoming like a bit of a Grab. They're going to put a commission or a commission charge on all those bookings that's done, but they just lowered their rental fee, but instead they changed the model to do that kind of more variable and risk sharing with the taxi drivers. And the other rebound is that there's going to be a 18% increase in for all of us when we pay the trains, but most of it is absorbed by the government. I think our increase is probably only 2-3%. The government's going to foot the rest of the bill, and that will benefit their real business, because that's where they will collect the grants, because they are the ones who will collect the ticket revenue. Of course, most of the increase will come from the government through grants and so forth. So it's a rebound story for Comfort. And of course, last year they were hit in China. They had to give like 15 million of rebates. So these are some of the recovery that you're going to get for Comfort that's going to drive the earnings recovery. Propnex was the other one, but it was mainly because of the yield was attractive. But I think right now the yield is probably about 5%. The other slide, there's an error. They put 10%. Because the market, they didn't adjust for the bonus. Bloomberg. So we think the yield now is 5%, but it's a recovery because this year there's going to be, last year there were only 4,000 new launches, and this year we think there's going to be 11,000. So there's going to be more properties for them to sell. So last year there was a decline in the number of units. So this is the red line is the total number of private and secondary units that was sold. So although volumes collapsed quite significantly, their earnings in blue line, even to my surprise, actually was quite stable because they took a lot of market share. I think they grew their agents force to about 11. I think it's 11,000 plus now. So they have the largest agency. And one of the reasons we like Propnex is purely also because of their market share. They have like 40. So imagine any property that's sold, they have like 40 to 50% market share. I think it's about 45 or 46. So for every one property sold, for every two properties sold, one of them actually is through a Propnex agent. Because very hard to find many industries in Singapore with that kind of market share. Okay, sorry to rush at the end there. So for us, our conclusion is that with disinflation and slowing growth, we think the interest rates have peaked. We think long duration assets will be where the strength is, which is mainly REITs and any dividend paying stock. So that's why our stock picks are very skewed towards those that have dividends. We think the Singapore economy is resilient, and these are some of the dividend yielding stocks, namely the banks and the REITs. So these are where we see where the yields are. So with that, this is our research team. Do get in touch with us, but of course more important, get in touch with Phillip Nova, and thank you, and we are open to any questions if you have. I think we're going to Q&A right now. Sorry.
Yes, we are all. All right, ladies and gentlemen, if you have questions on what Paul has shared with us today, or if you have any burning questions about how the months ahead will pan out, this is your chance to ask the right questions, and Paul will hear insights from him, and hopefully that helps us to be ready for the potential opportunities that will be coming up. All right, if you have any questions, please head to the question box and type your questions in there, and we'll have Paul address them. Paul, I'm just gonna raise your profile to an organizer, so you should see the questions on your panel as well, and then we can address it as a.
Okay. Do you want to put?
Sorry, Paul, come again?
Sorry, is the screen okay for you, or you want to put another? Is that okay, or is it okay to leave the screen share here? Okay.
While we are waiting for the questions to arrive, let me just share our promotional slides in case you have missed it at the start of the webinar. Let me just show that on the screen. All right, you have two questions in the question box right now. Feel free to give us your thoughts on what they are. and we'll be happy to gain insights from your.
Okay, so I'm just trying to see how to read them again a minute. Okay.
It's easier, you can just extract the question box out. Just click and drag the question box, and it should be easier read.
Okay. 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 Is one here a Keppel Corp price is very high now. Still still time to enter. Yep. Okay. So let me just go to our top. Yeah, we still like Keppel Corp. I think so far their track record in monetizing or selling assets has been pretty well executed within their plans, and they still have a plan to dispose of it. So okay, this is one catalyst, of course, what we the earlier screen where they had their plans to dispose another 5 to 7 billion. So that's number one. The second is their 4 billion asset co. So I mean, it's getting into the weeds here, but in part of the restructuring earlier, they actually disposed of some of the assets, rigs, that customers didn't take delivery. I mean, that's the truth of it. So they sold it in the form of notes. I think it's about 4 billion, and they earn like 7% interest rates. But if those assets are sold, which the market, to be fair, is a bit split on the ability to sell these assets. So the other trigger is that if Asset Co can sell some of these assets, then they will repatriate the money to them, and they will actually disperse it out to shareholders. So that is the other end. A healthy oil and gas market will actually help them. So that is the second catalyst for Keppel Corp. Yep. So that's why we still like Keppel Corp. And the third is, of course, the whole energy market. That is also doing well for them. So for us, we still think it's still a buy. I mean, our rating is $7.01. I think their own, probably they had some internal discussions, and some of it is sometimes, I think their own target might be even $14. But I mean, I don't know, we will want to see that monetization. So these are the two main catalysts for them. It's really property sales and, of course, the asset co. Okay, hope okay. Sorry, could you read the other questions? So I can't seem to be able to.
Yeah, sure, Paul. Okay, let's go to the top. Okay, have local bank share prices bottom?
Oh yeah, for okay, this is a bit tricky. In for us, we still like it fundamentally. My worry is that the price reaction to all the strong results hasn't been good. So that's my only worry. Like I told you, UOB did so. No, they had record earnings. Every bank announced record earnings, but it doesn't seem to move the share price. So the price action is a bit worrying in that sense. What I think is that until people get some inclination that that NIMs, because I think the worry for the market is that NIMs may be weaker than expected. So and you might only get to see that in maybe the third quarter. Why I say third quarter is because most of the banks shore up their deposits, fixed deposits, mainly in probably the third quarter of last year. So normally these are normally 10 month promo, 12-month promos, right? So when that higher cost of funds surfaces, that is where the market will only get to see whether how high or how stable is the NIMs. I think the market is just a bit worried about NIMs. So that's why even though they got record earnings, the market doesn't seem to want to reward them. Only OCBC, because the yield is high, right? So who wants to sell a stock that's giving you 6% yield, especially a bank, and they're only paying half their earnings as dividend. So I think maybe third quarter could be the real test. Although fundamentally we like it, no change on the fundamentals, but the price action is a bit worrying. Yeah. So that's my thought. And by the third quarter, that's when maybe there's a bit more clarity whether the Fed might cut rates. So that's also the other worry that the market has. There's no change in our view. We still like the banks, but this we think might be the overhang for the banks. Yeah. Okay.
Right,
The
on
next
to
one. Okay, the next one, sorry, I can see a
yeah,
bit here. Why ST
go for it.
Engineering is not, yeah. So sorry, yeah. Why ST Engineering is not your top 10 stock? Even they give, yeah. Sorry, ST Engineering, we don't cover it. Sorry, we don't have and because we didn't have an analyst covering it. But if the yield is 6%, then I think it should also be another attractive stock. The reason I say that is that if you look at the historical numbers of ST Engineering, it's always on a steady path, upward path. And the other thing that we monitor, I mean, when clients do ask about ST Engineering, is that we look at the Singapore defense budget. I think this year, don't hold me to the numbers, but I think it was up maybe 5 to 6%. Last year was maybe 4%. So I think the Singapore budget for defense actually growth rate, I think it was up 1 or 2 percentage points higher. So I do agree. I mean, just that we don't have coverage on it yet. So I'm not saying yet. I mean, we haven't had coverage for some time, because it was such a, in a way, kind of a bit of a monotonous stock, because it's always it's very dependent on the Singapore government defense budget, which is always growing, and it's a steady state. If you build a model, you just assume 5% growth every year, you won't get it wrong. And also with what's happening globally, there's a arms race now. I mean, it's pretty clear, especially when the Ukraine war happened. Germany said they want to spend 100 billion on arms. So it's pretty clear that there's going to be an arms race going on. And the problem with arms race is that it's really a race. When you see your neighbor spend 100 billion, that neighbor is going to try to top you. Then your other neighbor to the left will also want to follow and race. So this kind of not the most productive use of government money, but anyway, the arms race is going to be a spiraling and a positive for ST Engineering, of course. So I do agree. I mean, it does look an attractive stock. Okay, is that all? I can't see anymore. Yeah.
Okay, there's two more questions. What are your views on Seatrium? That's one. And the second one is, maybe you want to address that first before I read the last one?
Sure. For Seatrium, I think the fundamentals are not particularly excited, because I think they might still be loss making for the next 1 year or more. Yeah, because they still have to go through this whole integration. 1 plus 1 isn't necessary 2. So not necessary 2, might be 1.5, because you still need to, when you do an integration, obviously you need to I mean, you have to cut costs, right? So that means there could be something happening there. So that is one. But the one good thing is that there's a very high chance they might be included in the STI, in the Straits Times Index, because they're one of the largest market cap. So I think there could be a run on this. More tactical rather than fundamental is mainly because there's going to be there might be an inclusion in the STI. And I was actually particularly surprised that they actually crossed the 12 cents, because SoftBank, there were, I think, like, don't know, 30 billion of shares. I slipped my mind the exact number that were given to Keppel Corp. So and this 12 cents seems to be the so-called mental cost for most investors who own Keppel. So that's my thoughts. I think fundamentals are not particularly exciting, because their order book tripled last year. So most of these stocks, the excitement comes when they can continue to grow, to hit record levels for their order books, which I don't think that's going to happen this year, especially with the trajectory of oil price. But the angle for them is a bit more tactical and short term. It's a possible inclusion to STI. Yeah. Okay. What's the next? Sorry, I can't see. Sorry.
No worries, Paul. Okay, the last question is, why is there a divergence of stock performance for tech shares in Singapore? Example, AEM, Franken, UMS versus Nasdaq going up.
Okay, yeah. So, because the Nasdaq is being pulled out by the big tech now, the FANGs, it's mainly the FANGs. Every tech stock is except one, except Aztec, every electronics and semiconductor stock in Singapore all guiding downwards. But the good thing is that the market already, the expectations is already built. Number one. Number two is the one that's doing well is like like your Netflix, your Microsoft. A lot of them is running on the theme of cloud too. So that's one of the big drivers. And there's this AI lift. Also, everyone just announced they have an AI, and it kind of spurs the share price. So there's this AI, artificial intelligence halo around some of these FANG stocks. I don't know whether there's actual profit in it, but anyway, there's some premium rating when they announce AI, so that also helps this FANG names. And the way they cut the job cuts has been also one of the things that help the restructuring of their costs has been helpful. But if you talk about hardware in the good side, then most are down. I forgot to get the semiconductor index, SOX index performance this year, but I'm pretty sure most of the hardware names are affected quite badly. Yeah. So it's mainly those FANG names that have done particularly well. Just one last word from last point on this is that for some of our names here, like your EM or that, just be prepared to go back in already, prepare for growth, because although they are down cyclically, the supply chain, I mean, you speak to any of that, it's pretty clear that because of what's happening in China, a lot of them are getting new customers. So the next time there is a rebound, they might actually rebound even stronger because they've got a new customer now. So it's like, hey, I got a new customer, new program. A lot of them, especially applied material, not building up huge. I mean, they're going to build a new plant here anyway. So a lot of them are shifting out of China, if not already done so, already doing so. Yeah, China into Singapore and Malaysia. So those are the big winners. But again, you can't help it. I mean, this time around, there's just this downturn is real and it's going to last probably until the year. Probably we think until the year end. Okay, is there any?
Right, thank you so much, Paul, and thank you for being a wonderful audience as well. Until our next live webinar, do stay tuned and catch us for our next session. For the questions that we were not able to answer today, I'll send it over to Paul to have him type some short answers to you, so you will receive responses in our follow-up email as well. All right, thanks for being a wonderful audience, and till our next webinar, take care and all the best for your trading week.
Thank you.